What's up, ladies and gentlemen? Welcome to the Beat of Business with me, Ravi Wadan. And right off the top, let's just be honest, the pandemic has messed up the global supply chain for just about everything. I mean, the automotive sector doesn't have enough chips to build cars, we've seen lumber shortages, we've seen labor shortages, and we've even seen chicken wing shortages. Hell, yesterday I went to Nordstrom's to buy a white dress shirt, and they didn't have my size in the store or online. Apparently, the supply chain for white dress shirts has been disrupted as well. But if there's one industry or sector that has impacted all of our lives the most over the past year and a half, it has to be real estate. I mean, since the pandemic hit, we've seen a decrease in interest rates and we've seen a mass exodus out of big cities as people escaped their condos and their apartments, simply looking for more space. With the pandemic, most people were forced to work from home, go to school from home, do their workouts from home. Pretty much they did everything from home, and many people realized that when they are not allowed to leave their condos or their apartments the entire day, these spaces simply are not big enough to accommodate their needs, especially if they have families. When you couple declining interest rates with the demand for more space, you get a red-hot real estate market, and that's what we've seen over the past year and a half. Many people who wanted to buy homes either were priced out or they simply lost bidding wars. Many others just watched from the sidelines, knowing or anticipating that a market correction would inevitably happen at some point or another. Well, for those of you who have been patiently waiting to buy a home, or for those of you who have been waiting for the market to cool down just a little bit so that you're not in the middle of a bidding war to buy your home, there may be some good news right around the corner. When the pandemic hit, people lost their jobs and the economy took a major hit. I mean, businesses were shut down essentially overnight. Millions of people lost their jobs, and the world as we once knew it essentially came to a halt. And because of these extenuating circumstances, millions of people were not in a position to make their next mortgage payment. And as a way to counteract millions of people losing their homes, the government enacted mortgage forbearance programs. This essentially allowed millions of struggling Americans to either pause or reduce their monthly mortgage payments, which essentially allowed them to stay in their homes. Now, these programs are coming to an end and will officially be over as of September 30th, 2021. And with these programs ending, the real estate market might cool down even more than it has over the past couple of months. Now, for those of you that have been waiting for a housing crash, the end of the mortgage forbearance program isn't going to cause a crash. Sorry to burst your bubble, but it will impact market inventory by creating more supply, which will put downward pricing pressure on home prices. Let's rewind a little bit. At the height of the pandemic, more than 7.2 million homeowners were in the mortgage forbearance program, which allowed these borrowers to pause or lower their payments. Since these programs were enacted, the economy has posted one of the fastest recoveries in history. And because of this economic recovery, those 7.2 million homeowners that were once enrolled in the mortgage forbearance program have gone down to just 1.7 million homeowners. And in just a few short weeks, on September 30th, that number will be zero because the mortgage forbearance program is set to end on that date. Now, this doesn't mean that on September 30th, everyone in the mortgage forbearance program will be removed from it abruptly. Rather, borrowers will be removed from the program in phases that will span out over a period of several months. But what does this mean for the housing market? Does it mean that as soon as these programs end, a bunch of homes will go on the market? Does this mean that home prices will drastically decrease? Or does this mean that there will be millions of foreclosures? I'm assuming that these are all questions that you have because these are all questions that I had when I found out that the mortgage forbearance programs were ending. But don't worry, because I did all the research so that you don't have to, and I will definitely answer these questions and more over the course of this video. But if you could do me a quick favor and hit that like and subscribe button, and don't forget to share this video with your friends and family, it would be greatly appreciated. The end of these mortgage forbearance programs doesn't necessarily mean that the housing market is going to crash, but it does mean that there will be some impact on prices. Like I said, there are 1.7 million homeowners that are currently enrolled in mortgage forbearance programs. And for a little more context as to what that means, there are currently 80 million total homeowners across the country. That means that roughly 2.1% of homeowners across the country are currently enrolled in forbearance programs. 1.7 million homeowners enrolled in forbearance programs may not seem like a huge number, but when you consider that there are only 600,000 homes for sale right now, according to Realtor.com, 1.7 million is a material number that definitely has the ability to impact prices. Let's say that out of those 1.7 million homeowners, 5% of them decide to sell or are forced to sell. Now that means that there will be an additional 85,000 homes coming into the market over the next few months simply because forbearance programs are ending. Now 85,000 homes coming into the market is a material number when you consider that there are only 600,000 homes for sale across the country. So adding another 85,000 homes to existing inventory would be an increase of 14.2%. Now, I don't know about you, but I consider a 14.2% increase in inventory pretty substantial. And the fact that there are only 600,000 homes for sale in the US today is a story in itself, because just a couple of months ago, that number was even lower at around 500,000, which was also the lowest amount of housing inventory in 40 years. So even if a small percentage of those 1.7 million homeowners that are currently enrolled in mortgage forbearance programs decide to sell their homes, and then you consider the fact that inventory levels were already increasing, it will definitely put some downward pressure on the housing market. All right, let's take a look at this chart that was provided by Fortune, and the data is actually provided by Realtor.com. And what you'll see here is inventory levels, housing inventory levels from January 17, 18, 19, 20, and 21, and the data goes through July 2021. And what you'll see is that from January 2017 to about Jan 2020, inventory levels remain steady at, hovering between 1 million and 1.4 million. We had some slight increases here. But what we've seen is that since, interest rates decreased and since the pandemic hit, we've seen inventory levels absolutely plummet. But what we've seen since about the first quarter of this year is that inventory levels are starting to increase, which is a great sign if you're a first-time home buyer or if you're just looking to get back into the housing market. In fact, according to Home LLC, a startup that provides down payment assistance to home buyers in return for a share of profits, their forecast suggests that the end of the mortgage forbearance programs will increase U.S. inventory of homes for sale by 11% by the end of the year. Like I said, this is probably welcome news if you are in the market for a house, because we all know that trying to buy a house in the past year or so has been nothing short of a nightmare. There's been a lack of inventory, and would-be buyers often find themselves in the middle of a bidding war. And let's be honest, nobody likes bidding wars, because even when you win them, you may end up feeling like you paid too much. And let's not forget that between April of 2020 and April of 2021, housing inventory actually plummeted by over 50%. So the fact that inventory levels are trending upwards is welcome news for a lot of us. And according to real estate research firm CoreLogic, over the past year, median home prices are up 17.2%, but they don't expect this unbelievable growth rate to continue for much longer. In fact, over the next 12 months, they expect a big slowdown in real estate market, with home prices expected to appreciate 3.2%. If you follow the real estate market or if you work in the broader real estate industry, you know that inventory levels have been coming up over the past couple of months. In June, inventory levels ticked up 8.8%, and in July, inventory levels picked up at an even higher rate, at a rate of 10.4%. And that number is expected to increase in the months to come as the market goes through its normal cycles and as mortgage forbearance programs end. But again, I want to reiterate, for those of you that are waiting for a real estate crash, it is unlikely to happen in the near future, and this can be attributed to many factors. But one factor is that there has been years and years of underbuilding, and even as we continue to build homes at a rapid pace, demand will continue to outpace supply over the next 3 to 5 years at least. And for those of you that think that the mortgage forbearance programs will end up in millions of foreclosures, that just isn't likely, because the housing market has appreciated so much over the past decade that even if people can't make their mortgage payments, they will have tons of equity in their homes. So even if some homeowners decide to walk away from their homes, they won't have to go into foreclosure. In fact, the majority of them will be selling their homes for a handsome profit. So when people compare this housing market to the housing market during the Great Recession of 2008 and 2009, they just aren't the same thing. During the Great Recession, millions of homeowners were underwater and had negative equity, meaning that their mortgage balances were greater than their home's value. And that's why you saw so many foreclosures during that time. This time, things are completely different. Even if people are unable to make their mortgage payments, their houses are, in the majority of cases, worth more than their mortgage balance. So the next time somebody tries to tell you that this housing market reminds them of the Great Recession, please tell them that they are two completely different things. All right, ladies and gentlemen, I hope you enjoyed today's video, and I hope you learned something new today. I'll see you all next time. Please don't forget to like this video, subscribe to my channel, and share this video with your friends, your family, and through your social media outlets. See you guys soon.